Welcome to Finding Proof, where we discuss all things early stage VC.
We're your hosts, Thanasis and Jenny of the Proof Fund, and our goal is to get to know the best seed and early stage VCs out there.
In this episode, we're excited to revisit Gabe Turner, who is now a partner with Sway Ventures out of San Francisco. We had spoken last year to Gabe when he was still part of the Draper Venture Network. Gabe, thanks for joining us today. And I'm pleased to have you visit us for a second time, which is great because we're now talking about the new firm that you're at. Tell us about Sway and what got you to join the firm.
Yeah, thanks, Thanasis, and great to see you again. And look, when we spoke last, I had my Draper Network hat on, and I'd been there for almost a decade running that alliance with Tim Draper and company. And I, for a long time there, I was watching from the sidelines and really wanted to play in the game, if you will, because I was helping a ton of funds form, a ton of funds helping them with their portfolio and making them exits. I was doing angel investing on the side. But my passion has always been in the consumer space and specifically in CPG and retail. I had done a business prior to investing in the sustainable food space. I was always passionate about the future of buying, really the future of commerce. And certainly COVID threw a lot of that in disarray, and those who were behind on e-commerce fell even further behind. Those who were ahead, I think, moved further ahead. And I thought it was an excellent time to dive into that space from the technology side. And so I joined Sway Ventures to raise a fund all around retail, what we call retail and brand, really everything that sort of e-commerce enablement, also helping brands that are both physical and digital, meld those two. That was my impetus for going to Sway, was to raise this fund.
So the firm has different target areas and raises different funds for each, or is that how you're structured?
Yeah, I'll explain. Historically, Sway has been kind of a mid-stage investor. They've had what they call their flagship funds, which are focused on kind of Series A, Series B, what we call in venture mid-stage. For others, that would all still be very early. But what they did starting about 18 months ago was launch these seed funds that are sector specific. So 5 of them that are in the sectors that they invested in from a mid-stage perspective so that they could have earlier access, build more relationships with at the start. They've launched in property or real estate tech, in fintech, in supply chain, and in retail and brands. In the future, we'll launch one in digital health. I joined my fellow GP, a woman named Shelley Kapoor Collins, who was running a fund herself called the Shatter Fund, which was focused on female-founded companies. And so the two of us got together, and we're raising this fund around retail and brands, and it'll be sort of seed, post-seed, everything kind of prior to A.
And how big is the target for the fund?
Our fund, we hope, will be 60 million and with a hard cap of 100. We are making good progress on our way there. That's roughly going to be the size of all of these seed funds. The Sway flagship is about 250 million that they're raising. Yeah.
That's exciting.
Yeah.
And what's the idea behind having different teams pursuing each one differently as opposed to having one big fund? Do you find that LPs like specific areas and therefore will come after that? Is a way to organize yourselves internally so that the scope of activity is more under check?
It's a good question. The reasoning was not for the LPs. It was because we felt that we could be more successful as a fund, and naturally LPs would appreciate that. We believe strongly that the specialists in each of these sectors will be better at both identifying opportunities, but building relationships with those opportunities. CEOs, when they're starting companies, really want to know that their investors understand the space, can really help them in terms of building a business, finding that product market fit, et cetera. And generalist VCs typically do well, call it in the mid and later stages where it becomes about scaling companies and injecting capital. And at that point, the CEO, the founder should have a good understanding of space and product market fit and all that. And so that the need or the importance of perhaps a specialist at that time isn't as relevant. But we believe really in the early stage it does. And so the way that Sway is set up is that for each of these funds, they've brought aboard specialists and investors who really know those spaces. Those kind of winners, call it, from the and by the way, we all kind of act as one big family at Sway. So it's not like we're in our own fiefdoms, like we're all actively working together to help one another fundraise, to look at companies together. For instance, the supply chain fund, a lot of the retailers I speak to are very concerned with supply chain these days, and much as they are with real estate. So I work with those two funds and we look at deals together. I get intel and advice from them. So it works nicely that we operate as one big family.
And is it just the two of you on the investment committee?
It's actually four of us on an investment committee because Sway has general partners at the flagship level. Each of those general partners sits on one of the sector funds. So Carl Carlson sits on our fund, who's a European active consumer and retail investor, so he knows the space very well. We also have a COO named Greg White who sits on our IC. So there's technically four of us at the IC at our specific fund. Yeah.
It's an interesting structure. And is everybody located in one location, or you're spread out geographically into many spots?
Yeah, it's funny. Geographically, we're very spread out, and as much as the sort of post-COVID life exists for many companies, but we're technically headquartered in San Francisco. And I was excited because I was like, oh, great, I'm in San Francisco, I'm Bay Area, I'm going to come in the office all the time now and see everyone. Of course, everyone is now spread. We have partners, my co-GP Shelley's on the East Coast, a lot of folks in Southern California. We have an office in San Diego, folks in Denver, and everywhere now. So geographically, we're spread. And I mentioned one of our partners is in Europe, Sweden-based.
And so about how many companies are you targeting for the fund, and what would be the average ticket size? And is that also on par with, I guess, the rest of the supplementary funds?
Yeah, most of the funds plan on, again, 60 million. We'll probably allocate that to anywhere from 20 to 30 companies. Check size can range really from this kind of pre-seed $500,000 all the way to 3 million. We'll have some for reserves, but the beauty of this model is that those companies that really take off from our seed portfolios, we have the flagship fund, which can then back their next kind of, call it A round. So it helps us allocate more of our money towards a wider swath of companies. So we don't have to have that much in reserves. Yeah, that is really the approach for most of the funds.
And when was Sway started originally, and what's the legacy of the history of it?
Yeah, and I appreciate you asking because it's a neat one. It's not, they started in 2013. First fund one was around then. They took different iterations, had actually different names, but one of the founding partners, Brian Nugent, who was a former operator and exited various companies. And what I loved about Sway was really all built by operators. So these were not just finance folks coming into venture, because it was folks who really built and sold tech companies and had a real passion for building them. And so started with a fund in 2013, their first flagship, another fund around 2017. In sort of relative terms, not that long. In venture terms, they've had a few cycles, they've been around. And to me, that was important, really having a firm that has a nice portfolio. We've done 65 deals already out of those first two funds. Another piece is part of Sway that I really like, and something that was really instilled in their DNA from the start, was co-invest. Of those 65 deals, I think over 40 of them they put out towards their LPs and other friends to co-invest with them. And as proof, you guys know that's a big part of your strategy, is a big part of ours, to go and share deals. And I think it's helped them really build a ton of relationships around not just the Valley, but globally with investors.
I actually think Andy Baer used some of our offices for a while out in the DC area. So he was a great guy, although I never really talked to him that much about what you guys do. So it's great to learn some more about it.
Andy is a wealth of knowledge there in DC. Obviously, he's done a ton with government and in various departments. And so he's helped so many of our portfolio companies just understand how Washington looks at technology and how they buy technology. And we got to introduce you to Shelley too, who's, like I said, my co-GP, who's now moved from the Valley to DC.
What sort of trends are you seeing in the retail and brand space, and how is the current market potentially impacting those?
Yeah, for the last 3 years, it's like I said, it's been a space that has undergone so much disruption. Those brands, those retailers and e-tailers who perhaps, like I said, weren't doing enough on the technology side to have a robust offering, have fallen further behind, much further behind, and they're trying to play catch up. Those like Amazon, Shopify, and the like, who really found the momentum, and even prior to COVID, and all the market share have only increased. So we're living this post-COVID world where retail is coming back. I've been speaking to a lot of retail real estate experts who are excited about the prospects. People do still enjoy that experience of coming into a store. Where we get excited is, and we're going to work with both. We're going to have LPs in our fund that are both physical retailers and digital retailers. And we love the ability to really make that connection. And one of our big thesis is the convergence of physical and digital. And what we mean by that is, look, when you shop on a website, on an e-commerce store, they're typically going to know a lot about you, right? What your preferences are, especially if you're coming in signed with some Facebook or Google. They're going to know way more than you than if you walked into a store physically. We want to change that to some degree. These companies and brands to have a lot more insight into who's walking in their store, what their preferences are, how can you make that experience much more personalized and tailored to them. And I think that personalization trend is one that is very important and that we're seeing a lot of big brands trying to activate. You mentioned the market. Yeah, I think the reality is that retailers are sitting on a lot of cash right now. During the pandemic, they held off on investing, and especially in physical stores, laid off, unfortunately, a lot of people. And so those who had an online presence, an active one, actually did quite well. You saw a lot of consumer spending go from services to goods, and they're sitting on a lot of cash. And then a lot of them are wondering how then to reinvest, right? Do they go and put more money back into their physical stores? Do they put more money back into the storefronts? Do they do stock buybacks? Ideally not. But yeah, so we obviously have an exciting time ahead, and we think it's a really good opportunity for investing and doubling down on technology in this space. We have a lot to say, and I can talk obviously more on our thesis there.
Do you think that COVID has forever changed the way people shop? And I ask this because the other day I was walking around our neighborhood where our office is in Reston, Virginia, which typically had a lot of the high-end stores that you might expect in a nice area. And this time I noticed that a lot of them had turned over. There were still a bunch of empty spaces that are looking for a new tenant. And I was just thinking that as people got more used to shopping from home, does that really create a totally new dynamic? Is it like, do you need a different retail store now or a totally different experience? And what does that mean?
Yeah, I think the short of it is yes. Like it absolutely accelerated. They say it sped 10 years up in the course of one or 2 years. So advances that folks were anticipating were going to come in the late 2020s, we're now coming today. And so you've seen that not just in shopping, but across the board, the way we communicate, the way we work, which is whether it's at home permanently now or it's hybrid or some, I think you're going to see that with retail. You're already seeing it where companies have to get and brands have to just get a lot more creative in how they utilize physical space and where they place stores and where they don't. You're seeing suburbs, for instance, now having this resurgence. A lot of stores that were shutting down their suburbs in favor of maybe a few flagships in urban dense areas are now rethinking that strategy, given that more people are working from home. So I think absolutely there will be, looking back at sort of the pre-COVID and post-COVID, and that there'll be a big difference there. And I think most brands are putting real thought into how to make the digital experience smoother and how to use the digital experience to further enhance the physical. We're starting small things like curbside pickup, right? Or at least being able to do a lot of the research before you come into the store to therefore make the store process very seamless and frictionless. We've met with a ton of companies in the fast checkout, easy checkout space in physical. So whether that's just walk out like an Amazon Go type technology, or things like scan and go tech, where again, you don't really need to ask for help or even stand in line. You just walk in, you scan items yourself, and you walk out. And we think that's only going to continue, that trend. You saw Walmart and Sam's Club do big announcements and that. And you got to watch the big players in the space because they are leading the pack as far as deploying this technology at a wide scale. And so it's been helpful. We were just at Shop Talk in Las Vegas last month when we announced one of our first big investments. But we met with a ton of big companies and retailers, and they are very eager to now roll out technology that maybe they were going to hold close to chest and just test out for the next half decade or decade. They are just rolling it out as quickly as they can because they know that consumers are eager to see change in physical retail. They're seeing change in digital constantly, but they're eager to see it at their stores and improve that store experience.
On that, what does the future of retail look like? If we were to walk into a physical retail store 10 years from now, what does that experience feel like? What does a store look like?
It's, right off the bat, it's personalization. Hey, Jenny, welcome back. Something that at least alerts the store to your preferences. And it's, hey, I'm here to try on blue jeans. And okay, hey, 2 minutes, meet you at the dressing room with a stack of blue jeans that we know your size and we know your style. And they'll be there waiting for you to try on. And, oh, you like this? Well, it'll be home by the time you get there if we don't have the inventory here. But no, it's that hyper-personalization. But I think it's also, you mentioned Thanasis experience. And I think experiential retail is something that's been talked around and tossed around. Like, what does that actually mean? We met with a company that is turning really places that we gather into retail experiences. So it's not just having to walk into a clothing store or a furnishing store, but it's the places that we already go to, like cafes or co-working, how to sort of delineate spaces within there that are maybe stores or areas of commerce. So especially useful for brands that are D2C, that are online only, that want to experiment with physical, but they don't need a whole storefront. And they certainly don't want to take that cost on. Okay, how do we allocate a few shelves in this cafe for you to put your product and have consumers test it? So I think what we define as an actual retail store may undergo some change. And again, that's part of what we discuss with our real estate team. It's also the future of real estate and where people gather, I think, is changing post-COVID.
Yeah, and we made an investment last year in a company called Swiftly that is bringing a kind of more integrated online experience to grocers and retailers through product experience, integrating online and offline, but also advertising. And what we noticed, which was compelling, was that a lot of the traditional retailers were scared of what was happening with Amazon and seeing how Amazon is attracting not just product dollars, but also advertising dollars. So do you see that trend where like traditional retailers are saying, if we don't shape up and if we don't compete on the same level, we're going to lose our share to Amazon?
Absolutely. They've been scared for a long time. And like I said, those that weren't putting a lot of money into it before are certainly doing so now. And they're probably only further behind now. And so, yes, everybody is trying to figure out how to carve their own niche in the kind of e-commerce space. We only have so many eyeballs and so much attention, and it is hard for a retailer to compete with Amazon, given how much share and honestly how much data and knowledge they have of us. There are, I think, some probably lights at the end of the tunnel for some of these, and that if they can really adapt quick enough and really view kind of their physical, for instance, storefronts as a place of experimentation, of bringing back a customer in. I think, for instance, Best Buy is doing a better job now of retooling their stores and retooling their store assistants to think of their retail store as a bit different, because they're not going to compete online with Amazon. So how do you compete? They started with Geek Squad, right, as a way to say we're now a repair and services space. Can we become more of an experimentation with technology space? Can we become somewhere that you come to get educated, much like an Apple store did with Apple products? How do they become that? Or all kinds of products where you come in and learn about different tools and technologies. So I think retailers have to really be smart with how they're competing with some of these behemoths, and take a note out of the page from some of these small young upstarts, right? The D2C companies. I'll tell you that one of the first deals we're going to do, and the deal that we announced at Shop Talk, is a platform coincidentally run by Brooke Shields. She's launching something called Beginning is Now, which is a way to really take her community and her following and create a company around it, because she's been putting out a ton of content for years around health, wellness, rest, and beauty and the like. And now she's finally putting products together and coming out with things that are really focused on the 45 plus female demographic, which she argues is not highly marketed to, whereas the teens and 20s are. And she says it's kind of like Pampers and then products for geriatrics when you're dying. And there's a whole swath there that's missing. And so that's going to be a really interesting platform, because it's going to take really a community-led commerce approach. So an influencer has now the ability in 2022 to build a real sort of whole commerce unit around, where you don't, in the past, she would have to partner with the likes of a Target and a Walmart or what have you. Now, through a few APIs and partnerships, her company can handle all elements of running a commerce business, be it the sourcing and supply chain, be it the distribution and delivery, all the product development. And so it's really this amazing ability for an individual with a small team to build a whole commerce. And we're excited to back her. We're obviously going to be putting a lot of technology we're going to experiment with a lot of technology that goes into that platform. And we're going to see what works and what doesn't, and obviously back the stuff that works. So it's a nice kind of test lab for our fund to work with Brooke on this idea. So we're excited about that.
Yeah, no, I can see why. And on that note, it would be helpful to hear about the criteria of the fund a little bit more, and then maybe elaborate into some other examples of additional companies that you guys are either looking at or have already invested in.
Yeah, Jenny, we hesitate to put really hardcore walls around our themes, because as a seed stage, early stage fund, we have to be somewhat fluid with our thesis. We want the founders to define what the future will look like. We're not going to define it necessarily for ourselves. But that said, yeah, there are a few things like community-led commerce, which I mentioned, which is a big theme for us and why we're backing Brooke and her new company. I talked about a digital physical convergence. So we've looked a lot at startups that are tackling how retailers get more data about the customers, be in store or online. We really like the idea of personalization, of AI, really driving a lot of the future of how we get to know our customers. So anything that kind of touches that, like I'm much more focused on kind of underlying infrastructure, the enablement of e-commerce. Shelly, my partner, has a ton of experience with brands, and we'll be much more focused on diving into those brands, backing a few that are technology driven. We've looked to talk about a frictionless checkout, things like that get us very excited. Metaverse, maybe less so at this point, but we're certainly dabbling in it. We have a portfolio company within Sway, a prior fund called Omnivore, which is an AR VR company that has gotten us really smart about the metaverse and what can happen, especially from a retail kind of shopping. So we are excited about it. We haven't placed any bets yet specifically out of our fund, but the criteria is it really has to hit the future kind of buying experience. And that's kind of it. Obviously, they'd have to hit our sort of metrics and be at a place where it makes sense for our fund to invest. Sway is typically a lead investor, so we want to be able to lead deals and have a meaningful ownership percentage. As long as those kind of numbers pan out, we don't really want to put too many hurdles or boxes around what we will or won't look. The inbox is open to take intros for certain.
We talked a little bit about now you see people more dispersed, and I'm just curious about in our business, which is usually most of the firms are pretty small, right? And usually concentrated in one, maximum two offices. What is that world like as you see people moving out? And I've heard stories now of several groups that used to be, like the latest one was a group that I was talking to where they were in New York, and then the partners took off and basically moved to their second homes. Second homes became first homes. So what does that mean for our business? Do you think that you can be just as effective doing it that way? And how do you work together and gel as a team?
It's a great question. I think something we're certainly confronting, and whether venture fund or other companies today is probably dealing with some variation of that question when it comes to maintaining culture and retaining people. Because I truly think historically, times are always tough at one point or another when you're working for a company. Not every day is going to be rosy. The things that really kept you there and through those tough times were being able to show up at work and go to lunch with somebody or go have a drink with somebody and vent or what have you. And then, okay, I'm gonna get through this, right? This is why I'm here, is because people like this. And now you lost that. And I think you saw a ton of turnover during the pandemic, the great resignation call. I think we would have a lot less if we were still in person, because now you just don't have those avenues to really connect and, like I say, gel with people. So at Sway, I know, and I was being onboarded during this time, and many people have gone and new things, and it was challenging because you weren't meeting a lot of people in person. I made a point to come into the office at least once or twice a week, and I encouraged everyone who was in the Bay Area to join. So we set a day or several days in the office. We're going to be there, which is really nice and helpful. With VC, it's its own animal, where I think historically we've always been, what's the word? It's like the Wild West, right? Everyone's their own cowboy, they say. They come together for Monday meetings, and then they're off meeting with companies, having and what have. So I think our industry maybe handled the sort of disbursement a little bit better than others. But I think VC in venture shops, culture matters too. I know, like Sway and Brian Nugent, who's our founding partner, has made a real point to gather our team as much as possible. We've done gatherings in our San Diego office, here in our San Francisco office. We are big about doing events. We like hosting dinners with founders and with investors and everybody in our ecosystem. And we've continued, as soon as sort of the gates opened, you were allowed to do that. We were hosting dinners and events in our SF office, in our San Diego office, and elsewhere. Shelly, who's my partner, has been great about coming out to the West Coast all the time. She happens to be here this week again. And we've managed to have that physical interaction, which I think is super important. But yes, our Monday meetings are now virtual. Our pitch meetings with startups are often virtual, just at least the first few. And there's pros and cons around that, certainly. So I think I wouldn't be the one to paint this rosy, I can work from anywhere and digital's fine. And no, I really do think there's a lot of value with being in person and having that water cooler chat, as they say. When I am in person, I feel like I get like more done just sitting with somebody across them for a day than 100 Zoom meetings. Because I wouldn't call you or ask you to have a Zoom meeting for something that I may just say to you in person. And so all that sort of gets lost if we're not together. So I think it's a challenge. I mean, I'd ask you guys the same. If you have any good ideas there, please share, because it's, I think, something we're all struggling with.
We've approached it the same way you have, which is a hybrid environment where we pick days when we're in the office and other days where everybody can be remote. It's a work in progress.
Yeah, there's no substitute to FaceTime. So I totally hear what you're saying. Obviously, the topic of the market right now is top of everyone's minds. How are you and Sway as a collective fund thinking through that? Are there any predictions that you have? What are your thoughts there?
Boy, I wish I did have predictions. I was at the Draper conference earlier this week. I'm still quite close with the team there, and so I was invited as alumni. And then, funny enough, Kathy Wood was there from ARC, and I think they had booked her months ago, not knowing that like Monday when she's there speaking, the markets are absolutely tumbling. And so a lot of good questions for Kathy. I'm trying to get her crystal ball a little bit. I certainly don't have a crystal ball. Look, the correction might finally be here. The correction we've been talking about for, I think, over a decade now. I remember so many years being like, we were seeing little bumps, like, okay, that's it. This is it. It's the start of the correction. This one finally feels like maybe it's real, but again, I don't know. Maybe this is just a temporary thing, and the sort of Fed will cool off, and inflation might come back down, at least stabilize, and then that's it, right? As far as the interest rate hikes, I don't know, but I can tell you the way we're reacting to it within Sway, there's obviously different, I'd argue, pros and cons of all this, because on the one side, you're seeing valuations come down to earth already. A lot of rounds, I could tell you, that I've been involved with have taken 20, 30% haircuts. And so as an investor going in and look at deals, particularly in an early stage one, the seed one like ours, where we're thinking another cycle or two out, it's fine. Bring the correction. Naturally, we want our fund closed before things go any further down. But honestly, for us having a much longer time horizon, we're not too bothered by these sort of hiccups in the market. Now, when you talk to our later stage companies, and our fund is trying to exit companies, I'm sure you guys are, like, yes, short term is more important. LPs want returns, there's liquidity that's needed. And so when these things create hiccups in the market and that short-term horizon is a little more cloudy, it puts more pressure on companies that need to raise and need to close those rounds ASAP. And then those companies that were looking to exit, obviously that IPO window is closed. And M&A could be something interesting, though. We might be seeing a lot more M&A in the coming years if really valuations do come down. And look, these companies, like I mentioned earlier, are still lagging. Many of them are, as far as innovation goes. They need to make acquisitions. And so we might see M&A pick up quite a bit, is my prediction.
So moving on to our 4 standard questions segment, we're looking forward to hearing your answers. Our first question is our NVCA question. The National Venture Capital Association advocates for public policy that supports the venture community and the American entrepreneurial ecosystem. If there was one thing that you would change about the VC industry or one policy that you'd advocate for, what would it be?
I think last time I was on here, we talked about the need for NVCA and the U.S. government to really back kind of or go after anti-competitive measures. We talked a lot about IP theft and what we were doing with China and how important that effort was. I think this time I would certainly double down on that. But I mentioned I was at the Draper conference earlier this week. The topic because Tim is launching this thing called Draper Decentralized, essentially a way for democratizing access to early stage companies, to private companies. A lot of folks have attempted platforms, and actually platforms are succeeding that allow individuals, not funds, but individuals to get into companies with smaller checks. And I think Angels was at the forefront of this, and now you're seeing a ton more platforms that are even targeting later stage and pre-IPO companies. Part of the challenge there, and Tim cited a specific instance where he's got a show called Meet the Drapers, where he interviews companies and founders, and he cuts checks to those that he likes, and he allows the public that's watching the show to also digitally, through a platform, put in money into these companies. He said that the FCC kind of got after them and had them close that down. I would argue that, look, not everybody has to be an accredited investor, right?
Yeah, I was gonna ask about how that worked out with regulations.
Yeah, look, there should be a limit, I'd argue, right? Where at some point you don't want to lose grandma's 401k. So there should be a monetary limit, but there should be a lot more freedom to invest in private markets, in private companies. And it shouldn't be so restricted and overregulated. I'd argue it is now, because so many of the gains in the last decade have been made in private markets, not in public. By the time these companies went public, they had seen all the growth, and unfortunately at that point they were nosediving. And so you actually hurt the public and market investors and 401ks a lot more. So that'd be my focus for our advocacy groups and lawmakers, is really allow the American public to access these companies at an earlier stage, have them provide as much information as is reasonably possible, and allow these people to make informed decisions. Yeah, that's really somewhere I think we should put a lot more of our energy.
Yeah, no, absolutely. And we've had multiple guests come on the podcast and echo the same thing. And it's a really valid point. So hopefully that is something that can be worked on now and in the future. Number 2, if you weren't a VC and money wasn't a concern, what career would you have?
Well, it's a great question. Yeah, I'm in this kind of retail and brand space. I think it'd be fun to have a few brands of my own. I don't know whether that'd be in fashion or back in food, but I think practicing what you preach and a lot of the cool technology that I'm playing with and interviewing, I'd like to deploy it myself into a company or to a brand. So I think having I live in a cool little town up here in Northern California. It's called San Anselmo, and I'd love a little storefront here that my wife and I could run. And so that might be the thing I'd do if I didn't need money. Although I don't want to go out there and say that no retailers make money, because then what am I doing with my job? But I think that'd be a fun thing to do.
And what would you sell? I know that you said that you weren't sure.
My wife's an interior designer, so it'd probably be some housewares or something that she uses our house to collect, like all this stuff. I'd love to have a store where I just get rid of all of it.
Awesome. Number 3 is, who is someone that you look up to and why?
Yeah, and I actually recall that I think I answered my dad last time, so I have to go with my mom. It was just Mother's Day. My mom is someone who sacrificed a lot for our benefit, for my brother and I's education, for instance. We moved over from Uruguay, from South America, when I was very young, and my brother, and she was an architect and a graphic designer, but couldn't actually practice here, didn't speak English very well, wasn't being hired by anyone. So she actually turned around and just dropped that career and became a teacher so that we could go to a good school. She became a teacher at a private school, and so we got to go there for free. And so she really just did everything for us and for our education, and obviously paid off. And that's somebody that now that with my own kids and thinking about sacrifices that I would make, and we're seeing how big of a deal that really is, right? To go and move countries and change careers for the benefit of your kids. So she's someone I very much look up to.
Sure, she'd be happy to hear that too. Lastly, what is the best piece of advice that you've ever received?
Oh boy. Just recently, I was reading a post about conviction, right? Because as investors, we often have conviction, and the difference between having high conviction and being stubborn. And I like that differentiation that this investor was making. And have high conviction and believe in what you're doing, but don't be stubborn. Have the ability to have your mind changed. And I think that's good advice across the board, especially in these times we live in, where people are divided and they like to hear their opinion and in their echo chambers. I think it's so important to have your ears open and have the ability to change your mind on things, be it investments or politics or the way we look at things. So I'd hold that advice dearly.
Great. Gabe, thank you very much for joining us. Appreciate you joining us again and enjoyed learning more about Sway. Good luck with the new fund.
Thank you so much. Always my pleasure. I hope to be back again. And you guys take good care, and please come visit so we can do the in-person thing at some point.
Definitely.
And follow us on Twitter @ProofVC or on our website at proof.vc.